Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's May 17th. I'm Frank Curzio, so Wall Street Unplugged. So I break the headlines and... tell you what's really moving these markets. So much going on. Debt ceiling debates, possible downgrade of U.S. credit. The Fed, are they raising? Are they cutting? If you ask 100 people, 50 are going to say one thing, 50 are going to say the other. You have no idea what's going on. Economic data is all over the place. Showing inflation and showing signs of deflation, stagflation. Be nice to just fall asleep. I wake up a year later, and the market's at the same price with all the risks and all the craziness, but I'm here to try to make sense of it for you. And I want to start with the Fed. Whether they're raising or they're cutting. And we just saw another number come out. Retail sales grew 0.4% in April. Grew, right? Retail sales grew. Used to getting a negative number there. Now it's growing again, but it was still slower than the 0.7% expected. This is retail sales, right? This is the consumers. What I found interesting in this report is if they strip out autos, just like they strip out like core, food and energy at a CPI. So they have retail sales. Remember, retail sales grew 0.4% in April. But they always strip out autos in this because it's volatile. This way you can get a pure number. That's what they do with the core, again, excluding food and energy. So when you strip out autos, retail sales grew the same percentage, 0.4%. Does this mean there were no auto sales in the month of April? I want to see how that works out. I thought that was interesting. When you strip it out, it's either lower or higher, and it was exactly the same. There's no impact from auto sales, I guess. But either way, retail sales are growing. They thought it was going to grow even further at 0.7%. Again, coming off a few negatives. Now, when you look at all the data as a whole, and you want to know whether the Fed's going to cut or if they're going to raise, which is significant, right? We're pretty high. They raised rates by 1,900% the fastest, right? From 0.25 to 5%. The fastest rate hikes percentage-wise in the history of the Fed, right? Never did this before. But yeah, we're still seeing some companies hold up. The market's holding up pretty well. You say, yeah, it's really 5-7 companies accounting for most of that. When you look at the CPI, and this is what you need to understand. When the CPI is growing at 9% last year, then, or even you could say 9% for a month or two, then 8%, it's still growing, right? So you're not seeing a decline where, wow, we just paid 20, 30% more, now we're declining 15%, now it's better. You have to realize all this tightening is going on, raising rates, the Fed taking money out of the system now, instead of buying bonds, selling bonds, right? So quantitative tightening. Trying to lower the money supply because we decided to go nuts with trillions and trillions and trillions of dollars being spent. But all this nonsense, you still have the core growing at 5.5% year over year. And again, I mentioned this in past podcasts. It's important, if you really think that the Fed's going to cut or they should cut, and the core growing at 5.5%, they're expecting that to be at 2%. We're not going to get down to 2% this year. So if they cut, good luck. But let's look at some other things, like Las Vegas. You see record sales for rooms. The strip casino rooms average $209 a night from January through March. You know how much that's up year over year? 28% year over year. 28%, and even better. You say, well, it's the pandemic. No. That's bullshit. If you go back to 2019 pre-pandemic, that's a 40% increase. But there's no inflation here. There's nothing. People are looking at all this data. There's no inflation. Rooms, 40% increase since pre-COVID. Look at property values. Look at property values in Miami. Try to buy something down there. Try to buy something in Vegas right now. I mean, these are all-time highs, property prices in some of these cities. Food prices still up. Vegetables, you look at eggs, they're like, well, eggs came down. They're still up 20% year over year. Pet food's up 15%. Bakery products up 13%. Rents are still up 8%. 8.8% year over year. I know rents are going to come down. We heard that for 12 straight months. Rents are eventually going to come down. Just like inflation's is transitory. Sounds familiar, right? How about electricity? We all got to kind of pay that still, right? Electricity? Yeah, that's up 8% year over year. Tuition, forget it. Record highs. Government pays for it. They're going to raise tuition forever and ever and ever. Makes sense. Biggest corrupt system on the fucking planet next to healthcare. Sorry to curse. I don't mean to curse. Cable, satellite, streaming up over 5% year over year. These are bills that we pay every day, right? Wages rising, right? CPI. Unemployment rate lowest since 1969. I mean, you can point to energy down 5%, appliances down 10%, used cars down 6%. Again, you have some data points showing that decline. But when I hear Jerry Siegel goes on there and says, inflation's disappearing. I mean, this guy, I could see that he's not a guy that's traveling like crazy and going to different places, right? I could see that. Most economists don't. They're not like the fun guys at the party. They'll go to a conference here or there where they have to speak. They speak, and it's monotone. It's hard to get an economist to really be exciting. That's why nobody ever wants to take economics, even though it's the most exciting thing in the world if you taught it right. It's about everything around you. Prices going higher. Your neighbor, who's a fireman, just bought a $200,000 or $150,000 car. Are you kidding me? Like things like that you could see. How much you're paying for milk. How much you're paying for tuition, your kids. How's everyone it's everything around you. It makes it so exciting, but yet, again, bell curves and based on productivity growth, this is where it's, we don't want to hear just, again, try to make it a little bit interesting, because it is. It's fascinating. Economics, it's trying to measure actually the future and predict spending patterns, what people are going to spend on. All of a sudden, nobody's buying big ticket items anymore. Pelotons, appliances, and used cars. Nope. We'd rather spend on services. Look at the travel industry. Everything's much, much higher. But if you're looking at this data that I just pointed to, which is almost everything inside your house that you're paying for, which is much, much more than you're paying even month over month, how can the Fed lower rates? It doesn't make sense. Maybe the market crashes or we have a further credit crisis type in the banking system, which it wasn't really as bad as everybody makes it sound. Again, we got 4,000 regional banks. Not too bad if a couple of them get taken over or go out of business. The main ones, there's no systemic risk there, right, according to the Fed. So, yeah, they're worried about inflation. That's their primary concern. And if that's their primary concern of getting down to 2%, which Powell made it crystal clear, we're not looking at 3%. It's not even on the table, 2%. That's not happening for at least another 12 months. So if you think of it a cut, something drastic has to happen if the Fed's going to cut. Otherwise, they're going to make the same mistake that they made in the late 80s, which is considered the worst mistake in Fed history. Again, things that I covered. Now, let's talk about how companies are positioning themselves. When I say companies, the big money, the hedge funds, because there's so much money in the system. When you look at companies, some of the private equity companies, supposed to do bad in this environment, right? They use leverage and it's much more expensive. These guys are sitting on hundreds of billions of cash. KKR alone, $100 billion in cash, dry powder, $100 billion. Then you look at the big guys, look at the big tech companies. When I could picture how the CEO, you have Tim Cook, you have even Microsoft, you have Google. The CEOs wake up and like, oh, you know what? I'm not going to buy $60 billion of our stock. Let's go with $70 billion. Yeah, all right, $70 billion of our stock going to buy back. What's that? A bigger market cap than probably 400 of the 500 companies, the S&P 500? Yeah, that's going to be a buyback. Apple, what is it? $90 billion buyback. Yeah, we're just going to buy back $90 billion. I mean, they're so big, right? But when you look at the 13Fs, if you're not familiar with 13Fs, guys, that's where all these companies, the investment companies need to report. I think if they have over $100 million in assets under management, they need to report their buys and sells over the past 3 months. However, there's like a 2-week lag, but they could buy this early in a month and they could sell it just before this report or a week or two before this report is published. So it doesn't mean that they actually still own these things. You have to look at the investment manager's style. If it's Bridgewater or something like that, they're in and out of stocks like in a second. Again, they're front running everything and it's not about trading on fundamentals and things they like. It's just about, looking at the whole system, the inconsistencies and making money off everybody else, right? And there's a reason why they're untouchable, because every billionaire, you look at the pension funds, they're all in these, right? They're all making a fortune off of them. So it's not ever going to be regulated. It works until maybe it doesn't work and the whole system blows up. We'll see. There's thousands of algorithm systems on top of that one that try to follow. So maybe you're 6th, maybe you're 10th, maybe you're 80th, trying to squeeze out as much gains as possible. But who knows? Maybe they all say sell at the same time. That's an interesting story later on. that we could talk about. Not now. Because right now it's a debt ceiling. Will they come to terms? I don't know. I know that the debt's, what are we at, 32 trillion just about right now. And I know 2 years ago, I tweeted about this at Frank Gersio 2 years ago, the debt ceiling. I found this interesting. So I think they raised it. They had trouble, and then back and forth, and they raised it. It was $28 billion, and then they raised the debt ceiling. But it went from $28 billion to $31. It's about not billion, trillion, but about $2.5 trillion in the past 2 years. Okay, so now we're raising it again 2 years later. What the hell happened over the past 2 years that you spent $2.5 trillion? You know how much money that is? And we look at 31 trillion, 32 trillion, and we're not. But how do we go through 2 trillion? And look at asset prices at all-time highs. Maybe we saw the market come down a little bit. Maybe tax receipts are a little bit lighter than expected. But trillions? How do we spend trillions over the past 2 years? Well, $2.5 trillion. How do we spend that? What do you think they're going to do? They're going to raise the debt ceiling? I mean, there's no limit. And if you go back at the past debt ceilings, I've done the research on this. I mean, 1996, 2013, few government shutdowns here and there for like a couple weeks or whatever it was, or a couple days. The debt downgrade that we had. When you go back, we're looking at what was it? It was 22 trillion at COVID. Now we're this is pre-COVID. 22 trillion? Now you have COVID, we go up to 26 trillion. Then, 2 years later, it's 28 trillion. 2 years later, we're spending 2 trillion just to show you the amount of money on the debt ceiling and why this is crazy and why I think the dollar is going to continue to lose its reserve currency status. Right? When I say continue to lose it, I mean that percentage is going to go down. It was 75% of the total world currencies, well over 70%. Now it's at 59, 58%. It's going lower and lower and lower. Where do you think it's going to go? I mean, how much higher could we go on this debt where we're paying $1.2 trillion in interest payments? Are you out of your mind? That's an interest only. What are we going to do? We're going to raise the debt ceiling by $2 trillion. We're going to be out of that in a year. We just lost $2 trillion 2 years ago. How much more are you going to raise this? And now it's getting serious here, and it's resulted in a lot of countries going to hell with this, man. We got to find a different way. We got to wean ourselves off the dollar. And this isn't just coming from crazy countries like Venezuela or North Korea. We're talking about Europe. It's not just coming from Russia, who hates us because we took them off the SWIFT system and shut them off and closed our economy. I mean, now you're looking at China. Now you're looking at the Middle East and the Saudis doing deals with China, energy, LNG deals, and yuan. What the heck? That never, ever, ever, ever happened before. This is serious. So big risks here. Of course, they're going to pass it. Maybe they wait a week and, scared at everybody and there's going to be volatility, but they're going to pass it. It's going to happen. But a lot of crazy stuff out there. So how are you positioning? Well, if you look at the 13Fs and how these guys positioning, I did see one trend that I haven't seen before. Probably ever. Over 15 years easy. I've been analyzing these things, probably longer. But the largest increase, I've seen the largest increase in the big five companies than I've ever seen analyzing these reports. Apple, Google, NVIDIA, Microsoft, Amazon. Get over 15. I've never seen, usually they're buying, some of them are selling, and there's a lot of different names. You're looking at Appaloosa, David Tepper, Alliance, Bernstein, Baupost, which is Seth Klarman, Bridgewater, D. Shaw, Fidelity, Maverick, Movin, Third Point, Daniel Lowe, Pershing Square, Ackman, probably the biggest purchase they ever made in a stock, in Google, Viking. I mean, all these guys, all the research that I get, and there's a lot more of them, the amount of money going into one of those five stocks or two or three of them, I've never seen that much exposure going into them. Ever. And what does that mean? What does that tell you? That's the safe haven. That tells you that they're nervous on the markets. Because those are the new safe havens. They're going to have companies with incredible balance sheets. Companies that just, again, hundreds of billions that they have access to. Just told you, $90 billion buyback for Apple, $70 billion buyback for Google. And they're not trading at obscene valuations, insane valuations. But these are, you have the optionality of these companies that not only you're buying them and they're earning money off of, interest off of these big balance sheets now, and they're buying back their stock, which is always great. But now you have that optionality where these guys are using that strongest balance sheet in the world to invest in other companies. So the optionality for growth, where it's very, very difficult to find growth in this market right now. It's not easy. You look at revenue, average revenues are what? Growing 1.5%, I think, and earnings are down year over year. You're not seeing a lot of growth on average in the market. So why don't I park my money here where these companies are doing better and they have great balance sheets, and if the things fall 10, 15%, they're going to buy back even more of their stock. So the fact that you're seeing so much buying into this area of the market tells you that these guys are nervous, and they should be, because what do we see from the Fed chairman? What do we see from Powell? Bumbling. I mean, again, this is a market that there's no playbook for. There's no remember what we did? There's no playbook for pushing $11.5–12 trillion into this market because of COVID and not taking it out yet when everything goes back to all-time highs. That's why you're seeing inflation continue to go higher in so many different areas, to the point where, and those are serious areas that I mentioned. Those are, electricity. And yeah, you could say with declining energy, you're looking at all the costs that you pay. Even food costs are still going higher. They're going higher. They should be declining by 5–7% of what they did with interest rates. That's what, under normal circumstances, that's what happens. Why do you think the Fed was so fooled about inflation being transitory? They've never seen anything like this in history. The amount of money injected, the amount of money sloshing around out there. When $90 billion, $70 billion buybacks. 20 years ago, I don't even know if these companies had these kind of market caps. They're buying back that much money. You look at KKR, $100 billion in dry powder, continue to raise money. You know how much money's out there still? And people might be looking at this going, Frank, wow, my business is struggling right now. Holy cow, it's not that easy out there. It's not, but these big companies have generated so much money. When you look at inflation, just the bills you pay, they're still high. And if the Fed raises, I'm telling you, inflation's going right back up to 8–9% almost immediately. I would say 2–3 months later, you're going to see it trend tremendously higher. And room rates up 40% since pre-COVID. Where's the decline? Forget about, hey, it's slowing. You're still going to have to pay 40% more than you paid in 2019 if it doesn't grow anymore. And it's still growing. Oh, it's slowing down inflation. Like, how much more could people pay these incredible prices when they're seeing, some of them are starting to see their job cuts, but yet it's not really showing up in unemployment. Lowest level since 1969 because services. People need, that's a booming industry right now for services. But it's incredible. So you have this back and forth, constant back and forth. I mean, you watch TV, just think if you shut it off and came back like 5 months later. And what are you going to see? 5–10% in the market? In either direction, maybe. Could be a little bit worse than that. But it's kind of amazing that we're seeing this. The one positive I will say about this market is you're expecting a recession. Most people are. And the companies see it. They're seeing the slowdown. That's why the major companies are cutting back costs. The major technology companies are cutting. Almost all companies are cutting costs right now. Very few are spending more this year than they did last year, especially with CapEx, ways to grow your company. Again, M&A and stuff like that. They're cutting back. They see in the slowdown. So if you see it, that's a good thing. They didn't see that if I sold treasuries, holy cow, I would have to take those losses, and these banks didn't see it, right? That's a surprise. We talk about commercial real estate. I still think that could surprise, being a lot worse. But what is it that we don't see? That's going to really push the market down. But overall, earnings are still incredibly high. But you get hit more. I mean, it's back and forth with the market. It's so hard to judge, and it's all over the place. But I could tell you, for those of you looking for the Fed to start cutting, maybe they pause, maybe they keep up here, but there's just no way they can cut because, man, I mean, they probably already reserved their reputation, but this is something, the writing's on the wall of something that you should never, ever do again, and they're about to do that. I don't see that. If people think they're going to cut, they're crazy. Not if Powell's serious saying he needs the inflation rate to 2%, CPI 2%. He's not getting to 2% this year. He's not going to get 2% this year. It's impossible to get 2% this year. It's almost mathematically impossible to get 2% this year. It is. With rentals and the lag in rentals, which, again, real estate accounts for 30%. I don't want to get too far into the weeds and the details and the numbers behind it, but it's almost mathematically impossible to get down to 2% this year. It's almost impossible to get down to 3% this year. Let's see. By the end of the year. We'll see. But then what do we have today? Well, actually, yesterday, it was Home Depot. Home Depot came out. reports Q1, their earnings, $3.82, which was 1 cent better, but sales fell 4.2% year over year. That was to $37.2 billion, worse than the $38.5 billion. So they missed by more than $1 billion. It's the worst revenue miss for Home Depot in 20 years. Now, Home Depot's, look at it, it's a pretty big deal, this stock, right? It's a major play in both S&P 500, especially the Dow, having almost double the weight of Walmart because it's double the price. And despite Walmart having a $400 billion market cap, which is higher than Home Depot's $300 billion, close to $300 billion. If you look at the way it's calculated in terms of the weighting, even in S&P 500, as a greater index and earnings influence. A lot has to do with like the Walton family, the huge stake in Walmart and stuff, but it reduces weighting in the S&P 500. That's because, when you're looking at Walmart. So people look at Walmart and say that's the biggest retailer. Home Depot, when you look at the major indices, has a much bigger presence than almost any other retailer, especially in the Dow, but also in the S&P 500 when it comes to earnings, right? When it comes to earnings and their influence. But more importantly, what did Home Depot say, right? Because it's all about guidance. That's what I tell you about. The guidance is absolutely horrible. Horrible. Full year 2024, so all of next year, right? They're reporting first quarter 2024. They said earnings they expect to be down 7 to 13% year over year. So they reported, they're saying they're going to earn about $15. They had a big estimate that you could drive a truck through, but if you take the average, that's $15. And if you're looking at the expectations, we're about $15.75. That's a major, it's a major hit. It sees full year 2012 revenues down 2 to 5% year over year to $152 billion. That's from $156, $157. Also sees same store sales falling 2 to 5% compared to 2022. It doesn't get much worse than that guidance. And the stock's only down about 1-2% right now. Yeah, that's how much it closed, down 2%. It was down like 5% yesterday. It's going to be, but that's not too bad, considering this is a pretty bad report and the stock's been down, I think, 10% for the year. But the bad news here for Home Depot, okay, and they may do a great job, and they're going to do a great job cutting costs like all these companies do, and it does have a super strong balance sheet. But this is a company that it's hard to see things getting better going forward, especially over the next 12 to 18 months, because it's directly impacted by higher rates. So higher rates, you have mortgage rates much, much higher. They were 3%, where they close in at 7%, 6.5%, 7%. It means fewer homes are going to be built. It means much fewer refinancing, right? Where people take that money and reinvest the home through new projects. I mean, that's why they're having HELOC loans now, which are like temporary lower loans, home equity lines of credit. They're starting to boom again because the refinancings, most people have their mortgage rate, I want to say under 4%, which they locked in, the majority of people. Maybe it's a tiny bit higher, but we're at 6 plus. 6.5 plus. So refinancing is going to be a little bit higher than that, and people aren't really refinancing. And that's a big part of Home Depot and also Lowe's, right? Do-it-yourself market. So I don't see rates falling much further from here. We may see a pause. But the next 12 months, at least maybe 18 months, you have this massive headwind for Home Depot. But if you take the $15 in earnings per share and the current price of $280, right? Price divided by earnings, that's the P ratio. Home Depot is trading at 19 times forward earnings. That's around where the market is. You say, well, it's not too bad. Well, that's really horrible if you think about it. Hey, look how crazy expensive it is for a company that's seeing sales and earnings decline year over year. That's an insanely high valuation. Okay, you can't just take that number of PE and say, okay, it's expensive or it's cheap without looking at the sales and earnings growth going forward or what the projections are. Because you could have a company trading at 30 times forward earnings. If they're growing earnings by 60, 70%, that stock is cheap. You learned that from Apple, Netflix 15 years ago that nobody wanted to touch at 70, 80, 90 Ps at 10, 15 years ago. And you wonder how they grow into these big market caps because they're growing exceptionally, much, much faster than the overall market. But when you see Home Depot at 19 and people are like, well, it's trading at, a market multiple right now. It is Home Depot. That's super expensive for a company that's telling you same store sales are going to be declined up to 5%. Earnings are going to decline much more than expected. Sales are going to decline year for year. And that's how you have to look at the market going forward, guys. It's not like Home Depot and I want exposure. Everybody has large cap exposure. You have it in your 401k. It's where do you want to position yourself in the right names? So if you're paying 18, 19% forward earnings for a stock, you better hope that they're growing earning percentage at shares, right? At sales. And if not growing earnings and sales or earnings revenue, then I mean, that's a really, really expensive multiple. But now you're seeing lots of big brand industry leaders trading at exceptionally high valuations while seeing the Home Depot, right? Earnings and sales decline year over year. It's not sustainable. You can't have that high valuation when you're not growing those earnings and growing those sales. Not when you, especially now we can earn 4.5% risk-free, 5% in one-year treasuries, or maybe it's a little bit lower than that, 4.5% by putting your money in an Apple savings account, risk-free. You might say, well, why is that a big deal? I mean, if you look, let's take the analyst estimates, and this is how I judge if a company is hated or loved, right? So if you have a lot of analysts that have a buy rating on it, it's usually loved. If not, it's hated, and a lot might be priced in. Well, there's 39 analysts that cover Home Depot. It's on an institutional research side. So that will be JP Morgan, Goldman Sachs, right? Those guys. 39 analysts cover. 23 have a buy rating. That's 60%. Okay, expectations are pretty high. Buy rating. Notice how nobody is selling, even though these earnings were much, much worse than expected across the board. Everyone's lowering their estimates now. They're not going to lower their target. No way. These companies don't do that. We need their investment banking business. We don't want to put a sell rating on. By the way, only 2 sells. Only 2 sells on Home Depot. So despite 23 buy ratings, the average price target is just $323. So we're looking from the current price right now, that's about 13% upside with a lot of risk, right? The average target price is showing 13% upside, but look at the risk you have to take with interest rate risk. And that headwind's not going away anytime soon for Home Depot. I mean, housing definitely peaked and coming off its peak. Some areas are good, but most areas, that interest rates are double. Mortgage rates are double, more than double than they were 18 months ago. And you're looking at a company with 13% upside, but yet they're not growing earnings or sales and trading at expensive valuation compared to, again, earning 4.5%, 5% risk-free. What's better for you? Now, in tomorrow's Wall Street Unplugged Premium podcast, because that's our premium version, we charge $10 a month for it. You get a free newsletter, trading newsletter, all that stuff. And thank you so much for getting lots and lots of new subscribers. You can see the difference in that podcast. We're giving away recommendations, lots more names and stuff. But Daniel and I are going to break down a list of 20 industry-leading names, trading at 18 to 19 times forward earnings per share, just like Home Depot, that are much, much better buys than HD. Why? Because they're expected to grow earnings and revenue a lot faster than Home Depot. And they're not going to be as impacted and have that risk from those higher rates like most housing stocks are. I'll give away 2. These aren't ones that we're going to recommend in Dollar Stock Club. Again, you have access to that portfolio as well. That's a newsletter just with $10 a month that you get. Dollar Stock Club, the trading newsletter, trading idea every week. But I'll give away 2 right now, Meta and United Healthcare. So I bring up my list. Again, we have 20. There's probably about 40 stocks I could actually give you. I'll give you 20 on Meta. So look at Meta. It's trading at 18 times forward earnings. It's growing its sales at 34%. Right? Let me just look at this really quick. So this is Meta. And I listed, and I have this, all of the S&P 500 companies based on revenue growth, sales growth, and their PE ratio. So if you look at earnings growth for these guys, and let's see. So Meta is growing earnings at 32%, sales at 8%. Trading at the same multiple of Home Depot. Which one do you want to own? What about United Healthcare? Right? They say healthcare costs have come down in the CPI report. That's bullshit. United Healthcare just raised my rates. I mean, Trump premiums, everything. I don't know anyone in the world that's paying less for healthcare than they are right now compared to yesterday. 1 month, 1 year, 5 year, whatever you want to take. They just continue to raise. That's what happens when you have the government paying for stuff. Unlimited pricing power for these guys. And insurance companies, stuff like that. We all know that. But United Healthcare is trading at the same multiple as Home Depot, yet growing earnings and sales at 12%. What do you want to own? We're going to list another 18 names, at least another 18 names. I'll probably I just went through it really quickly. But I'll share those names with you. And Daniel's going to share them as well. Tomorrow's podcast, which is Wall Street Unplugged Premium. Also going to recommend one of those names for our Dollar Stock Club portfolio that we believe has over 25% upside over the next 3 to 6 months. Really cool name. Let's see if it's under the radar, but these are industry leaders, a name that you might have heard of, but most of you probably don't own. So also we're going to be highlighting a few under-radar names that caught our attention in the 13 Fs on both the buy and sell side, right? So I talked about the names of the big companies and how much money is going into them. But what I like to look for is just like sells that maybe something that they bought recently. And we're not talking about guys that have an active, it's called active or an active manager is someone who's buying and selling right away. That's usually like the algos and stuff like that, right? So I'm not talking about Renaissance and things. I'm talking about bigger names that take positions, and usually they add over time, over years, that blew out of some of these stocks right away, which is not a good sign. Or some smaller names that caught my attention. I just couldn't believe how many big names these guys really put their money into. Usually it's not that many. Some of them are buying here and there, but almost every one of them across the board has put money into this. It's kind of like putting money, instead of a money market account, putting into safe haven. That's how I'm viewing it. Okay, you can have a different opinion on that, but that's what they really are. Those are the safe haven stocks now, those large NASDAQ companies, 5 or 6 of them. We have some under-the-radar names that I like to see, just some buying. I'm like, wait a minute, why are you buying that stock? Or it's totally out of favor, and you got a good manager buying. So we're going to cover that as well. Again, it's going to be in Wall Street Unplugged Premium Podcast, which is tomorrow for all the premium members. So, guys, a lot going on. That's it for me. Any questions, comments, feel free to email me, frankkerseyresearch.com. That's frank@kerseyresearch.com. I'll see you guys tomorrow. Wall Street Unplugged Premium. So take care.